everyone. This is Marshall Gittler, Head of Investment Research here at FXPRIMUS, bringing you the day's scheduled events for Friday, February 5th. The only major indicator out during the European day today is German factory orders, which will no doubt be out by the time you see this video, so I won't discuss them. Other than that, the day will be spent waiting for the U.S. non-farm payrolls at 13:30 GMT. That's the big indicator of the month. Strong employment data should encourage the Fed to keep hiking, while any weakness might convince them to stand pat for longer. The market's looking for a relatively robust rise in payrolls of 190,000, although after the stronger-than-expected ADP report of 205,000, some people may have upped their forecast. That would be a bit below the recent trend of 229,000 a month over the last 6 months, but that would still be quite reasonable after the enormous rises in December and October. The market will also pay attention to any revisions to those earlier strong figures. To be really supportive of the dollar, though, the figure would also have to show a rise in earnings and a rise in the participation rate, which are announced at the same time. The reason is the Fed basically wants to see a healthy job market. One part of that is that demand for labor should be rising, and therefore the cost of labor should be rising. This has indeed been happening. The rate of growth in earnings has accelerated from an average of 2% year-on-year in 2014 to 2.2% average in 2015, and it was 2.5% year-on-year in December. However, the market's forecasting that the rate of growth fell back to 2.2% year-on-year in January. That could be a negative for the dollar. Another aspect of a healthy labor market should be more people coming off the employment rolls and into the workforce. That would mean a continued rise in the participation rate. The participation rate hit a bottom of 62.4% in September and has since crept up to 62.6%. That's still quite low by historical standards, but at least the trend is upwards. No forecast is available for this indicator. The unemployment rate is expected to stay at 5.0%. Only an extreme NFP number would be likely to change that. Now, it'll be interesting to see how the market reacts to the data. On the one hand, there could be some relief if the number is weaker than expected, as it would discourage the Fed from hiking again anytime soon. That could help risk-sensitive assets such as the Australian dollar and stock markets. On the other hand, more weak U.S. data just adds to the evidence that maybe the Fed shouldn't have hiked in December in the first place. As usual, the dollar would probably weaken in case of a miss. This graph shows how eurodollar moved in the hour following the non-farm payrolls the last 6 times that it missed its forecast. Curiously, though, the dollar strengthened 4 times and only weakened twice. On the other hand, the dollar gained for at least the first 30 minutes when it beat expectations. So it seems to me that its movement has more to do with the market's view on the dollar than with what the number is. In today's case, the market seems to be negative about the dollar for the moment, so unless it's a pretty strong beat, the dollar might move lower. At the same time, Canada releases its employment data for January as well. The market expects the unemployment rate to stay at 7.1% and for the economy to add 6,000 jobs, down from 22,800 in December. As the Canadian economy is increasingly affected by the weak oil price, there's a danger that unemployment may tick higher and job gains lower. This is Marshall Gittler, Head of Investment Research at FXPRIMUS. Get more market insights on our education pages and turn your trading ideas into action with FXPRIMUS, the safest place to trade.